Right. Before we look at our example number 2 of IAS 28 paragraph 22, I first want to cover IFRS 3 paragraph 42 principle. IFRS 3 paragraph 42, business combination achieved in stages. When the date of control is obtained, we need to remeasure our previous equity at fair value. If it's an associate, how do we do this? We will have to determine the fair value minus the carrying amount of equity, and this will be our fair value adjustment for group purposes. Therefore, debit or credit the investment, debit or credit our fair value. Okay, so guys, again, when you look at this, how do we determine the carrying amount of our equity of our associate? You need to know this by now. Include your cost, include your retained earnings, include your profit, and minus your dividends, and this will then be your carrying amount of your investment in associate. Then the very important rule, and as always, please remember to read the scenario. If there's amounts previously recognized in our OCI, we need to transfer this to our retained earnings. It will have normally a credit balance, your mark-to-market reserve or revaluation surplus. Therefore, to take this out, we need to debit our mark-to-market reserve or revaluation surplus and credit our retained earnings. Now, let's think about a scenario that can occur. The first scenario will be when we have an associate purchase additional shares. This will be a subsidiary, and we need to apply IFRS 3 paragraph 42, as well as for our level 2 students, IAS 28 paragraph 22. And then we may have an IFRS 9 investment, purchase additional shares, and this will be a subsidiary, and we need to apply IFRS 3 paragraph 42. Okay, so guys, I'm going to call this my example number 2 and then example number 3. Now let's have a look at a scenario where we have our associate, the investor purchase additional shares. This will be a subsidiary, and we apply IFRS 3 paragraph 42.